Glenn Freeman from Morningstar. I'm joined here by Stephen Van Eyk, Managing Director of Stephen Van Eyk Consulting. Stephen, if we can just ask you about what you're talking about, the China's credit growth relative to its GDP. Can you just expand on your comments around that today?
Sure. Well, in any credit boom, the thing you've got to look out for is how much credit is increasing relative to GDP, because obviously GDP is national income. So if you don't nip it in the bud, and credit growth is just multiples of the rise in GDP, you'll get to a situation where there isn't enough income in the economy to actually pay the loans or pay off the debt. And it's been my experience that kind of, say, leading up to 2008, credit growth usually is multiplying 2-3 times GDP. And if it keeps going for a number of years, it creates that situation where people start defaulting. Now, in relation to China, I think it's a whole new ballgame. One, because it isn't transparent exactly what that multiple is, but if you look at the economy, if you look at the amount of credit, you're making a guess, but I would say it's many times what it was in 2008. And how long has it been going? Well, that's hard to judge too, but possibly 2 years. And you also have to assess what is the bad debt situation in China as well. And that's hard to assess because if you look at their banks, the bad debts they're reporting are relatively low. But I did read an article which was quite interesting on how you get rid of a bad debt off a bank balance sheet. Basically, you create a trust, and so it's off balance sheet. And I thought, well, I wonder how many of these trusts there are relative to bad debts on the balance sheet and loans on the balance sheet. And I actually found a table, and it would appear for the top 6 banks in China that there are actually more of these trusts than there are loans on the balance sheet, which is a bit scary. And although you can't say that every one of those trusts represents a bad loan, because some of them might have quite legitimate reasons for being in trust, it does give you an indication that maybe bad debts are a lot higher than what's being reported. And credit growth, as we said before, I think is a lot, in terms of its multiple, is a lot higher than it was in 2008. So you can get some magnitude for the potential risk. What can the Chinese do about this? Well, the easiest thing to do is exactly what the US did, is actually lower their currency. That makes it harder to buy overseas assets. They become more expensive, so you get less of an outflow anyway, and makes Chinese exporters more competitive. What does this do? It means that it lowers the profits of American companies, European companies, etc. around the world. The result of a lower currency would be a fall in world markets. It could be actually a catastrophe. So when is this likely to happen? Everybody I asked about this and discussed this with said, don't worry about it, Stephen. They've got enough reserves for it to go the next 2 years. There's nothing you've got to worry about. It's fine. It's just been my experience in my career that every time somebody tells me it won't happen for 18 months, it happens next week. You know, the number of times is unbelievable. So I just think, yes, I don't want to scare the pants off people, but certainly that's an outlier that it's worth protecting your equity portfolio from, because at the moment profits aren't that great. But that's not enough to actually really pummel the market or anything. They just come off a bit if they're overvalued. But China's the outlier.